The worst consequences of Gorbachev's reform policies for the Soviet Union. When reforms were expected to save the economy. When people talk about the collapse of the Soviet Union, many tend to think about geopolitical pressures or the rivalry with the West. But if we look deeper, we can see that one of the most important causes lay inside the system itself, the economic and political reforms introduced during the Soviet reform era. The leader of this process was Mikhail Gorbachev. When he came to power in 1985, the Soviet economy had already begun showing signs of stagnation. Industrial production was growing slowly. Technology lagged behind Western countries, and domestic goods struggled to compete on the international market. In that context, Gorbachev believed the Soviet Union needed major reforms to rescue the situation. He therefore introduced a large-scale economic and social reform program, hoping to restore growth and modernize the country. Ironically, however, the reforms designed to save the economy ended up accelerating the system's collapse. In the end, the Soviet Union not only became financially dependent on the West but also lost the trust of its own people. Ambitious goals, but an ineffective system. By the early 1980s, Soviet leaders had already acknowledged a painful reality. The country was falling behind technologically compared with developed industrial nations. If we imagine the global economy as a marathon race, the Soviet Union at that time looked like a runner who had once led the race but was now losing stamina while competitors, especially the United States and Western Europe, were speeding up. To reverse the situation, the government introduced in 1986 a program to accelerate socio-economic development. The goals were extremely ambitious. For example, by 1990, food production was expected to increase 2.5 times. By 2000, industrial capacity was supposed to double. Housing shortages for citizens were also expected to be resolved. On paper, these goals sounded impressive, but the problem was that the Soviet bureaucratic system was simply incapable of implementing them. The massive state administrative apparatus cost more than 40 billion rubles per year. Yet it operated slowly and inefficiently. To put it simply, if a company has an overly bureaucratic and inflexible management structure, even a good strategy can fail in execution. And that is exactly what happened in the Soviet Union. Within only a few years of reforms, production began declining in 1987. 1989 marked the first state budget deficit. By 1991, the economy had nearly collapsed. Compared with 1985, economic growth fell from plus 2.3% to minus 11%. Gold reserves dropped from 2.500 tons to just 240 tons. Foreign debt increased from $25 billion to over $100 billion. For a global superpower, this was an extremely severe economic decline. When the goods supply system began to break down, another major reform decision came in 1987, the abolition of the state monopoly on foreign trade. Previously, all import and export activities were controlled by the government. After the reform, however, hundreds of enterprises and organizations were suddenly allowed to participate directly in exports. At first glance, this seemed like a step toward a market economy. But in reality, it created a huge loophole in the distribution system. The key issue was price differences. Inside the Soviet Union, many goods were heavily subsidized by the state, making them extremely cheap. But if those same goods were exported to Western markets, they could be sold for several times their domestic price. Imagine a simple example. If a shirt costs $5 domestically but can be sold for $20 abroad, what would happen? Naturally, many people would try to buy goods domestically and resell them abroad. And that is exactly what happened. Large quantities of goods were transported out of the country by rail for profit, leaving severe shortages in the domestic market. Basic goods such as sausages, toilet paper, shoes, dishes, became increasingly scarce. By the summer of 1989, the situation worsened further as sugar, tea, medicine, and cleaning products also began to disappear from stores. At one point, the country even experienced a nationwide cigarette shortage. As people struggled to obtain basic necessities, social dissatisfaction grew. Large miners' strikes erupted in industrial regions such as Donbass and Kuzbas, while spontaneous protests began appearing in major cities like Leningrad and Sverdlovsk. Half-reformed private economy and the rise of the shadow market. To stimulate economic activity, the Soviet government introduced the Law on Individual Labor Activity, 1986, and the Law on Cooperatives, 1988, which allowed limited private business. But here a contradiction appeared. On one hand, the state wanted to encourage non-state economic sectors. On the other hand, it feared that private businesses might grow too quickly and escape government control. As a result, numerous legal and administrative barriers remained in place. The outcome was a strange hybrid economy. Private businesses were allowed to exist, but were not allowed to operate freely. This forced many entrepreneurs to circumvent regulations. New business owners began exploiting shortages to raise prices sharply, while also engaging in financial manipulation to avoid strict controls. According to several analysts, by the late 1980s the Soviet shadow economy was worth up to 90 billion rubles annually. Food crisis and the decline of agriculture. Another paradox of the reform era was the growing food crisis. During the 1980s, the Soviet government invested more than 120 billion rubles into agriculture. However, instead of stabilizing production, the country became increasingly dependent on food imports. Domestic agricultural products gradually disappeared from store shelves. To cope with shortages, producers began reducing product quality. For example, butter contained more water. Sausages contained up to 30% soy. Real coffee was replaced by drinks made from chicory or barley. But the deeper problem was social. Millions of people left rural areas to move to cities, further weakening agricultural production. Inflation, unemployment, and falling living standards. While goods were becoming scarce, wages continued to rise. For example, in 1989, the average monthly salary was about 240 rubles. By 1990 it increased to 270 rubles. In private cooperatives, earnings could reach 450 rubles. At first glance, that sounded positive. But when money grows faster than goods, one thing inevitably happens: inflation. By 1990, unmet consumer demand in the Soviet market had reached 165 billion rubles. The consequences were severe. Inflation surged. The black market expanded rapidly. People's savings lost value quickly. According to economist Jude Winniski, the devaluation of the ruble caused Soviet citizens to lose up to 600 billion rubles in savings. At the same time, unemployment, rare in previous decades, began to appear. The anti-alcohol campaign and its unintended consequences. In 1985, hoping to improve labor discipline, Gorbachev launched a nationwide anti-alcohol campaign. In many places alcohol sales were heavily restricted. In regions such as Armenia and Crimea, large numbers of vineyards were destroyed. But instead of reducing alcohol consumption, people began producing homemade alcohol, consuming dangerous substitutes. Meanwhile, the state budget lost a massive source of revenue from alcohol production. According to former Prime Minister Nikolai Ryzhkov, the campaign cost the Soviet economy around $100 billion. The final collapse of the economy. By the early 1990s, the Soviet economy had entered a full-scale crisis. Global oil prices fell, the Comecon trading bloc disintegrated, and economic ties within the socialist system collapsed. The government was forced to borrow money from Western countries to cover its growing budget deficit. But these loans were not used to restructure the economy, only to cover short-term spending. By 1991, the budget deficit exceeded 20% of GDP. The ruble lost significant value. Inflation reached 25% per week. According to economist Oleg Platonov, the total economic losses caused by the reform policies may have exceeded $800 billion. The final lesson. Looking back at this period, one lesson becomes clear. Economic reform requires not only the right ideas, but also a capable system able to implement them effectively. If reforms are introduced within a system that is not ready for them, they may not solve existing problems. Instead, they can expose and accelerate the system's weaknesses. And in the case of the Soviet Union, the reform process